Hey, this is Tony Daly, and it's Friday afternoon after a great week of trading. A little bit of volatility in there. Was a pretty good week. What I'm doing is I'm scanning for some trades, and I want to take you through that process. So I'm looking to sell some premium for November, basically out about 45 days. So I would be looking at December strikes. So one of the things that I like to do is I set up the scan, and again, whenever I am looking to sell premium, I want it in the upper 50% of the IV percentile. And and here is the results of my scan, and we have the historical and implied volatility. So again, it's not the implied volatility, it's the IV percentile, which is the percentile of the implied volatility relative to the underlying itself. It needs to be in greater than the 50th percentile. So we have all of these to choose on. I don't want to pick anything that has earnings in the way. So we have Celg usually has a lot of play in it, and we have Nike and MJM. We have XLE as the ETF for energy. Let's take a look at Celg. So what we're going to do is Celg is trading for $151. Was up 280 today. The IV percentile is 54.2, and the implied volatility versus the historical volatility is 34 versus 29. So we have a little bit of rich premium. Taking a look at Celg, let's put that in there. Okay, Celg has been oscillating nicely within the 50 period linear regression channel, going all the way back to July. Notice how the 50 period linear regression has served very nicely as it oscillated in between. We penetrated it yesterday, and today we closed right at it. I'm expecting a rebound up to the 167 level, and we've got probably some very good major support here at the 143 level. So I'm going to look to do a one standard deviation trade. So let's look at the Analyze tab and see what we got. We've got December. We've got a measured move estimate of 15 points. So what I'm looking at is I'm looking at the deltas, and if we want, I could look at the 17, and we will sell an iron Condor. Okay, let me get rid of that. So we've got the 135, 130 on the put side. We're going to match it up on the call side. We're going to look at the 170, 175 call spread. So we are going to sell the 170, and we're going to buy the 175 call spread. Okay, so that leaves us with $1.20 credit. So we are basically risking 380 to make 120. And let's take a look at the risk profile on there. And we could see that from the risk graph right here, our break-evens would be out at 171, and our other break-even at expiration would be 134. So 134 and 171. Looking at our chart, and let's get an arrow. So 171 would be somewhere right around there, and 134 would be well below our support level. So if we wanted to go with those strikes, we're sitting right here. We have an upper level here. We have a lower level here, and I would be very comfortable taking this trade. And our deltas are about minus 1.96. And if we committed this trade, this is something that I definitely would be looking at to put on for Monday. So that's about it, and I will talk to you soon.